Ryan,
Yeah.
Casual Friday. Here we are wearing polo shirts, no suits, no ties.
That's what Casual Friday is.
Yeah. So we haven't done one of these in a little while.
A few weeks.
Yeah. I feel like, though, just given these last couple of days, we had the podcast episode drop today, put out the April video yesterday. We are definitely multimedia these days, no doubt about it. So today we're talking about, I think, the correction that we're still in the middle of, right?
Yeah.
What's going on with everybody? We always talk about stocks, but we're going to touch a little bit on bonds as well, because no matter how you slice it, things have been going poorly.
Yeah, I think obviously we've had a tough April, today being the last trading day of the month. We have somewhat of a gauge in the office in terms of when the markets are having more volatility to them, because the phones start to ring. You start to get more calls. You start to get more concerns. And so hopefully we can talk a little bit about what's going on, some thoughts about what's happened this month, and then also some thoughts on maybe what's going to happen going forward.
Yeah, and so we've got some, like we do for Casual Friday. Usually we've got some charts, and we're going to go over those in a second. I will say, just kind of for some context here, that the NASDAQ, as we record this here on the afternoon of the 29th, the market hasn't closed yet, but we're down a little bit more than 20% on the year. That's the NASDAQ. The S&P is down a little bit more than 12.5% on the year. Dow's down a little bit more than 8.5% on the year. So the brief rebound that we got yesterday has been all but taken out.
Yeah.
Right?
Yeah. And bonds are hovering somewhere around a 9% loss for year to date, which is a good, usually we don't bring up bonds in terms of returns just because they tend to be kind of slow and boring. But this year is kind of the exception to that. And so we'll spend a little bit of time talking about bonds as well.
Well, so this isn't going to be really big, but we can kind of see here that the fact that bonds haven't provided the protection that we like to have. If you're watching this on your phone or something, you can see the orange is the Dow, the blue is the S&P. So I don't have even the Russell, the NASDAQ on here, but the green is the AG, the
bond
index. So the protection that you thought you were getting this year from bonds hasn't come. Now, it doesn't mean that bonds don't protect, and they are correlated now with stocks, and diversification doesn't work. Of course, we're not talking about that, but you can see.
Yeah, and I would maybe even add that looking at these charts, you're looking at the endpoint, and you're looking at bonds having basically the same return as the stocks, and I wouldn't want people to think that they're the same risk, because again, we know that bonds don't go down as far in, let's say, a recession, right? And stocks always have the propensity to go down another 20-30%. I'm not saying that they will, but historically we've seen that. We don't normally see this from bonds. So the takeaway here is not to just abandon bonds just because they seem to be down just as much as stocks.
No, just because bonds aren't working right now doesn't mean they don't work as a diversifier, right? This is just a 4-month period in time. If you wanted to go back, 3 years, you can see that even though bonds haven't performed as well as stock, they're much steadier, right? And even if you're looking right here in the period of time when we had the COVID crash, we'll call it COVID crash. Yeah. They hung in there quite a bit better than the stocks did. So, there is a place for this. Just because, so we've talked a little bit about bonds. Let's dig into stocks some. And then what we will do is kind of finish up talking about bonds among other things. So let's add, we're going to get back to basics here with stocks and looking at how stocks have done over the long term. This is the chart that every advisor trots out when things get bad, but it really does help to add context and pull the lens back a little bit and see how things have gone kind of over the long term.
So
You want
yeah,
to
I
walk
mean,
us through this one?
yeah.
Oh,
So I mean, this is the stock market over 120 years. I think everyone can kind of see it does what we want it to do, which is to go up and to the right. And the market goes up even though it has bumps along the way. I will say, even with this chart, it makes the bumps look really small, even though when or the valleys look actually rather kind of small for the most part, even though when
sure.
you're in the midst of it, it doesn't feel like it's insignificant.
Well, I
But
mean, look here at the 1930s, kind of between 20 and 40. That's the depression, right?
right.
Find the Great Recession in here. Well, it's just that little blip up kind of on the far right hand side, right? Yeah, I mean, this is going back 120 years. Now, granted, things change, and we can't comparing where we are now to 1920. Some things are the same, some things are different. So comparing apples and apples, but suffice to say that um, we do well over the long run, and we follow this trend line ultimately. So good to keep in mind. Let's go on. Oh, I forgot to add our fancy banner. Here we go. Banner. So let's look not just at returns, but also earnings over time. And this is the S&P 500 earnings per share for the trailing 4 quarters. More the same, wouldn't you say?
Yeah, I mean, earnings go up, and obviously, if companies are making money, the economy is doing well, the stock market goes up. These things go, largely hand in hand. um, and we've had unprecedented earnings. I mean, when you look at the far right hand side, and you kind of start to see the chart or the line starting to dip a little bit, but you can also see that it was well above the norm.
Above
Um,
trend. Yeah.
Above trend by quite a bit, and that has to do with COVID and spending and the amount of stimulus money that comes. It comes and it flows through the economies, and profits go up because people are spending a lot more money.
Sure.
But that also settles itself down as stimulus money isn't flowing as
Yeah. Well, you can see how the line kind of curves above and below trend. And I think we call that reverting to the mean usually. And you're right. We've been flying, I don't know, flying high, but you can see we're as high off of the trend lately as we've been maybe ever.
Right.
Or at least let's say this, we're looking the last 70 years here. We'll call that ever. So it's no surprise, I guess, or shouldn't be too big of a surprise that we're getting some pullback. What I tell clients a lot of times is that the novelty here is the cause. The results are often the same, where we move higher or lower, or stocks become expensive relative to earnings, and they need to kind of come back down to earth. And so whether it's hyper growth or recession or something, and it usually comes in the context where we're in the middle of a correction, and the size of the correction that the S&P is in right now is decidedly average, even though it's being caused by record inflation over 40 years and rising interest rates for the first time in a very long time, and sovereign countries in Europe invading other sovereign countries in Europe. The results are average. The novelty is in the cause, I think, here.
Yeah, that's a good way of putting it.
So let's take a look at so we're seeing kind of this stability here. Let's take a look then at timing markets, because when we have unstable times, people, investors, seasoned, novice, and everything in between have this gut feeling to try and play this.
Yeah,
Whether it's to be opportunistic or get defensive.
Emotions heavily play into the markets at this point.
Right.
No one likes to see their money be lost, right? And
No.
And so as it goes down, as the time frame extends outwards, that this continues to the markets continue to fall, people start to have second guessing as far as what they want to do with their money, right? And so, of course, you go from being invested to your other option, which is not to be invested, and to pull your money to the sidelines and put them in cash. But then you can also see what happens with the consequences too, especially if you're wrong. And trying to predict the market is a guessing game about where we're going to be a month, 2 months, 3 months down the road. And so you can see here numerically, what happens if you miss the good days in the market.
Right. Well, and I hate hearing, oh, well, I'm gonna get out now because things are bad and may get worse, and I'll get back in when things are better.
Right.
That screams sell low and buy high, which is never an answer. And it kind of gets illustrated here in this chart where we're looking and say, well, if you're out of the market for the best 20 days, and oftentimes those best 20 days are rebounding off of the market hitting bottom, whenever the heck that is.
Correct. Right.
And you could miss, like if you miss the best 5 days there, you're out 5%. And if you do that consistently,
You're missing out a lot.
Yeah, you're missing out.
Yeah, one of the things I usually will tell clients is when they, say I'll get back into the market when it feels better is, obviously they're getting out at time when things are already down significantly, right? And I usually tell clients, like, when you feel comfortable with the markets and the markets are going, back up, I bet you the market's already up 20 or 25%. So you've missed that 20 or 25%.
You're feeling better.
Yeah, you're feeling better because you see the market's gone up for the last, month or 6 weeks, and now you're finally feeling comfortable. But again, you've missed out on, a significant rebound.
Yep.
It's just so emotionally you feel more comfortable.
This is like staying invested when things are down. It's like eating your broccoli. Like you don't want to do it, but it's good for you, right?
Yeah.
So eat your investment broccoli and stay invested, and don't miss the best 5 days or best 10 days out of the year, because you're going to tank your performance in the long run. Right. Let's go to the next slide, which is looking at the probabilities of stock gains over a period of time, because over a period of 4 months, stocks can certainly lose money. Lord knows they've done it here in the first 4 months of 2022. But if you take a look at this chart, it shows that the likelihood of gains over the course of 1 year for the last 71 years is 74%. And it only gets better with time.
Yeah.
Over a 3-year period, stocks S&P gains 84% of the time. Over 10 years, it's 92% of the time. And the best one, if you're invested over 15 years, it's been better 100% of the time, or at least with the S&P 500.
Yeah, this actually kind of goes hand in hand with that first chart we showed, where it was, the 120 years of the stock market. You can see that again, the chart goes and starts in the bottom left and goes up to the bottom, the top right. And that's, the longer you hold it, you can see that things head up over the long run. Yeah.
Well, the funny part here is if I told you that, hey, if you do something, you're going to have a 74% chance of improving your returns. Those are great odds.
Yes.
And then they only get better from there. Only get better.
Yeah. And that's to match, I think, too, if you think about the 1 year, 75%, or basically think of it this way. For every 4 years, you're going to have 3 years that go up and 1 go down. So right. On the flip side of things, too, you can also say you do need to know, once every few years, you're going to have a down market.
Absolutely. And, it's not even to say that this year is going to be the down market. We've been down 4 months. Right. We've got 8 more to go. It's a long way to go between here and there. Just looking back, like 2018, many people's portfolios were negative in 2018. And that's the last time we were getting those meaningful interest rate increases. But really, 2018 went sour the last 3 months of the year. It wasn't a bad 12 months. And then 2019, everything rebounded like gangbusters. And so even on those annualized numbers, it's only showing brief periods of time, because this is all kind of fluid. And with that in mind, the longer that fluidity is allowed to kind of go, the better chances you are for better returns. Let's take a look at the next slide, which are valuations and long-term stock returns. You want to roll with this one here, Ryan?
Yeah. So this one's, I guess, a little bit more technical. Basically, the yellow orangish line is your stock valuations, and think about it as valuations are where, like, are stocks cheap or stocks expensive, and the higher the orange line is, the cheaper the markets are, and the more expensive they are, the lower the line is, represented by the axis on the right hand side. Right. Basically, as we know, when stocks are generally cheap, you usually have a propensity to have higher returns. Yep. So this is just an indicator to kind of say, maybe what are some expectations for the market in terms of its future returns based upon how expensive the stock market is today.
Yeah.
And again, you kind of look at that the blue line is representing basically how returns have correlated to the valuations of the market in the past.
Yeah.
And kind
Over
of
the next 10 years. Yeah.
over the next 10 years. So, basically where we are with that orange line on the far right hand side, it kind of says, maybe returns are going to be in the 5 to 6% neighborhood for stocks over the next 10 years. So,
Right.
not that we're going gangbusters with stock returns, but 5 to 6% returns are still good.
Yeah. Well, I think, yeah, I mean, the returns have to fall in line with earnings, or the price earnings ratio. So if prices are flying high, one of two things needs to go on: either earnings need to go up or prices need to come down. And that all gets reflected in the S&P. And you can see, like you said, it's pretty clear that these two lines need to intersect every once in a while. And we are the S&P 500 index gain loss. The blue line is operating well above the orange line and probably needs to get back in line, I guess you could say.
Right.
Let's keep rolling, because we're talking about corrections also. If this Casual Friday is about perspective, long-term perspective, this is one of my favorites, because this shows how often corrections happen in the S&P 500. And on average, corrections happen once a year. But also, average is a bit of a misnomer, because average means it's either above or below. We rarely hit average.
Right.
Last year, though, we had one correction last year, and it was exactly 10%, I want to say. Or last year, we didn't have a correction. This year, we've had a correction. The only dip that we had last year was 5%. Didn't even amount to a correction.
Yeah, and I'll just to clarify for everyone, because I know I get these questions sometimes in meetings and phone calls. People get, they hear the word correction, they're like, "What does that mean?" Or we say bear market, and they're like, "What does that mean?" Right?
Right.
So correction, is defined as a 10% drop,
Right.
while a bear market's considered a 20% drop or more.
Right.
So 10% drops, which again, Brian's saying is correction, happen frequent enough that this is actually more normal than we actually think it is.
The abnormality was last year. Last year was weird because it was so calm.
Yes.
And we had a couple in 2020, obviously because of COVID, none before that, but a couple then in 2018, a couple in 2015. And you can see, coming off of the Great Recession, there were a few. I mean, people forget, but 2009, 10, 11, those were all like really, I don't want to say sketchy years, but everybody's really worried. Double dip recessions, W-shaped recoveries. Greece is going bankrupt. Our U.S. credit gets downgraded. All of these things were going on. So you can also see they kind of, at least in the past, maybe not in the last 10 years or so, but they've kind of come in bunches also,
Right.
which just shows that when you have some volatility, you're going to have more of these. But I look at this also, and you look and you say, well, people in 2000 were 2001, 2, 3, and 4, lots of corrections in those years. And even 2007, 8, 9, 10, a lot of corrections in those years. If you went back to investors who got out of the market because of corrections, do you think they wish they had stayed in during those corrections?
Absolutely.
I bet you they wish they doubled down during those corrections.
Yeah, and I would say, as some of these corrections cluster and happen in multiple times in a year, or happen year after year, I do think that clients somewhat get used to it, knowing that the market's just volatile. This is the way it's been for the last couple of years, and they're able to stomach the corrections a little bit more as they happen, because again, they've been happening.
Sure.
But again, more recently, as Brian mentioned, last year we didn't have one. Obviously, we had a big correction, or even the bear market from the COVID shutdowns in March of 2020. But
right.
the longer the stretches you go without having a correction, a 10% drop, it almost feels like when it does happen, it's super painful, because again, we almost forget that, like, what they feel like.
You're being generous. We get soft.
Yeah.
Markets go up and down. If they're going straight up, there's as much of a problem as if they're going straight down. Because one begins with the other. It's almost as if you get frequent corrections, the market kind of can slough off some of that frothy stuff,
for sure,
the high valuations. And so you can I would rather one correction a year, every year in a row, than none for a while. And you get 2008 here, for example, and it goes off the charts, Give me some
Yeah, I think it helps
consistency,
bring
even
some
if it
normalcy. It helps
involves
bring some
volatility.
normalcy to the market, is what it does.
Yeah,
Like a correction helps not let things get too far away from the from reality.
sure.
Yeah.
Um, okay. So I think we've established pretty well that long-term investing and not timing the markets generally turns out well. Let's finish where we started and talk again about bonds, because I will go back to the same kind of screen that we were on before. If we're just looking as we do this, just a reminder here, I'll take out the S&P just for some clarity here. The bonds, the ag, are down lower than the Dow this year. Now, I
Yeah,
know
and
the S&P is
it's
probably a better measure, but the
yeah,
Dow,
and you can see like just a few days ago, those two lines were touching, right?
right here.
And I had a client come in and I kind of explained it to them that it didn't matter what your stock to bond allocation was. It was
No,
if you're down, if stocks are down 10% and bonds are down 10%, you can have 100% bonds, you can have 100% stocks, or any mixture in between. So you really go from your 100% bondholder that may be conservative to your most aggressive stockholder that has 100% stocks, and everyone has the same returns,
right.
which is not normal given, again, everything being down. You usually expect that I have more bonds in my portfolio, therefore my return shouldn't be so bad in a market like this. But
Right.
again, this year's unique.
I will point out one thing. The difference between the orange and the green line is the green line is not as bumpy.
Yeah, for sure.
Right. You don't have, so whether you're going up or going down, bonds are less volatile. Doesn't mean you can't lose money or be down temporarily, but you can see you don't have those big downdrafts that you had, whether it's the end of January or in the middle of March and early April. You're not getting those huge downdrafts on bonds. They've been steadily churning lower. So with that in mind, I think Ryan, you were the one who picked this one this was from LPL Research, talking about fixed income yields and the different sectors and where they are in terms of their averages.
Yeah. So if you, the silver lining to this, no one wants their bond values to go down just as much as no one wants their stock values to go down. But we do have to have some kind of silver lining to such an extreme market, which is
Right.
when the bond values go down, your interest payments that you're going to be getting from these bond investments have gone up. So going forward, fixed income investors are going to be receiving a higher monthly or quarterly, yearly payouts from these investments. So if you're looking at this chart, basically what you're looking at, really want to focus on is probably the white lines. Think of the white lines over the last is the interest payments or the interest amount that people were getting from these various investments over the last 12 years. So it's kind of like your average.
Yep.
Don't pay attention to necessarily the extremes of the lows of the blue bars, but really the diamond is where we are today. So mostly our clientele is going to be investing into the fixed income sectors on the right-hand side of the chart. So you can see that's
above the median.
The what?
The ones above the median.
Yes, the ones above the mean too. So on the far right-hand side, the U.S. Treasury, the Municipal Bond Index, again, the Bloomberg Aggregate Index is the main index that's out there. And then the Mortgage-Backed Securities Index is another one that a lot of people have in their fixed income portfolio.
Sure.
As you can see with these, four points on the right-hand side of the chart, those diamonds are now representing a higher interest payment than what we've had as a median payment over the last 12 years. So that, again, that's a good thing that helps us also recoup some of the losses that have happened this year. If you continue to hold your fixed income, pick up that interest, you're going to see a nicer interest rate, payments going forward.
I think it's funny. I don't think bonds are covered as often by people because they are more difficult often to understand. Sure. For most. But it's just as important because they often, especially for people who are nearing or in retirement, people like that generally own a healthy chunk in bonds. And they're the ones who are maybe the most worried because the thing, like we said earlier, the thing that is meant to protect things hasn't held up quite so much. But your chart here really does a good job of demonstrating that over time, this can bounce back and maybe be able to add more protection than what we were actually getting from these bonds even in the last couple of years.
Well, yeah, the nice thing too is if you're actually getting a decent interest rate off your bonds, it does give you a little bit more safety in your portfolio, right? Because if you think about it, in future years, this is say hypothetically, your bonds are paying 4% interest.
Yep.
That's 4% that can help offset anything that's happening on the stock side. So if the market, your stock side goes down, your interest payments are helping to lift the portfolio. Versus again, if your bonds are paying 1 or 2%, they really aren't helping nearly as much to offset anything that's happening on the stock side of the portfolio. So
Sure.
this is again a silver lining to what's happening in the bond market. Not to say that we love what's going on, but
No, this
again,
is painful.
no one's going to complain about getting higher interest payments over the future years.
No. I think we are gonna in 5 years look back and say, man, remember that terrible year for bonds, the worst one in our careers and the worst one in many people's lifetimes. Oh, I remember that. Well, thank God they're doing better now.
Right.
I think that's ultimately how this lands. Okay. Well, lots of charts. We've actually gone for 25 minutes, believe it or not. So let's finish with fewer charts and something on the lighter side. What are you reading or watching this weekend?
If I have time, so a quick story. So my friend, I have two friends out in Vegas, and there's a F1 race coming to Vegas next year. And
I'm
so
well
I know nothing about. I've never even watched any kind of like race, like auto racing, like through an entire race in my entire life.
Okay.
It sounded really exciting. My friends want to go to it. So when I was going to Boston a couple of weeks ago, I downloaded some episodes of the docuseries on F1 for the airplane ride. I watched maybe five episodes. So I got into it. I know more racers than I did before, which was I only knew of Lewis Hamilton before watching these episodes.
Who's your favorite?
I don't know that I have a favorite. I feel like they're going to keep maybe introducing more people and then coming back to others. And so I don't know if I really have a favorite, but I do, now that I hear these people's names, I do have a face to put it with.
Okay.
It's been it's a great series. I will admit I'm behind on this, and most people have watched this probably years ago, but maybe if I get to another episode this weekend, that'd be good. What about you?
Cool. Well, we're for the record, we're Lando Norris fans in our household, which are the orange McLaren cars. And the Miami Grand Prix is not this weekend, but next weekend. So if you finish this up, you'll be able to watch the new Miami Grand Prix next weekend. So F1's good stuff. So for me this weekend, my plan is to finish the book called The 90s by Chuck Klosterman. I'm into it a little bit. It's okay. We lived through the 90s, so there's not a whole lot of novel stuff there for me. If I finish it up, I have another book called the Bogle Effect, which is a new one talking about Vanguard and Jack Bogle and how their ETFs kind of turned finance upside down. And then in addition to that, I'm playing in my first tennis tournament.
Yes.
So I've got 2 single matches Saturday afternoon, like not far apart from one another. So pray for me.
Yeah, no, you'll have fun. You're getting Brian now has the tennis bug, and so he's gonna be playing tournaments left and right soon enough.
Yeah. Well, I'll probably be reading those books on Sunday because I'll be too sore to move. That's my guess. Well, good. Well, I'll tell you what, Ryan, we're in a half hour. We'll leave it there. I'm glad we could kind of do this. It feels good to kind of get back on. I will say we're actually streaming on LinkedIn for the first time today, not just Facebook. Cool. So, and then we'll upload this to our YouTube page as well, so everybody can take a look at that after the fact. So, Ryan, have a good weekend.
You too. Thanks.
All right.